Hello, everyone. Thank you for joining us today. I am Sarah Campbell. I'm USDA's Beginning Farmer and Rancher Coordinator for the department, and we are very excited to be kicking off with our first tax webinar today. We have JC Hobbs, who's an Associate Extension Specialist from Oklahoma State University in the Department of Agricultural Economics, who's going to be talking to you about weather-related sales of livestock. We are going to be hosting a series of webinars and putting out a series of materials related to ag taxes, as we know that folks have a lot of questions about this, particularly when it comes to your USDA program payments. So we're very excited to have JC here today, getting ready to give you a great presentation on the topic. And just a couple of notes, we are recording. If you've got questions, please drop them in the Q&A. Amanda Robertson and I will be monitoring that. And then at the end of this, we will go through and get JC to answer your questions. Hopefully folks can hear us, see us, and I will turn it over to JC.
Thanks, Sarah. Well, as you said, have questions, put them into the Q&A. If you stump me, and I hope you do, what I'll do is I'll put those answers and send it to Sarah so she can send those out to everybody as well. Since this is the first webinar of this series, they can't help but get better. You picked a winner, in my opinion, taxes. They've got to improve after you talk taxes for a while. Anyhow, with that, we're going to talk about weather-related sales. Now, this is weather-related sales of livestock, and it's two sets of rules apply, but it's livestock sold due to weather-related conditions, those being flood, drought, those are the big ones, or any other weather-related condition causing a shortage of either water or feed. Essentially, what it's going to do is allows the taxpayer to postpone recognition of the income from the sale in periods when we're selling more animals than normal, so it avoids the bunching of income. Our desire here with this workshop or discussion is to help you be able to understand options, how to help your clientele, also help tax professionals prior to filing, understanding what's going on. So what you'll see in this presentation, I've got some tax code references just for the benefit of knowing what's going on and where they're at. Now, what sources of information, disaster information? The requirement is for weather-related sales is we have to be able to document that a weather condition caused the sale of animals in excess of what is normally sold. So for the presidential declarations, that requires a president making the issue information out there. It comes through FEMA. So the presidential declarations get us both sides of the coin. So we got two rules, and presidential declarations cover both. Now, FSA, Secretary of Ag declarations, and the Drought Monitor only give us two sides. I mean, the other side. So when we get into those two, I'll point out where the differences are and why we've got three different sources of information and when each of those do apply to our situation. Now, Secretary of Ag designations, normally there's a map. So when you go to Google and you type Secretary of Ag designations, you can find maps. And those maps basically look at the 50 states and gives you the county that the condition exists in the contiguous counties. Right now, and I don't understand why, but none of the maps are currently available. I checked last week. I also checked this morning. So there's no maps available, but we only have two states that have any declarations from the Secretary of Ag. Kentucky, two primary counties, so two directly affected counties, and then 7 contiguous counties due to the tornadoes this spring or this winter. And in Ohio, we've got 1 primary and 7 contiguous due to the excessive rainfall. So those are the only 2 states currently, and there's only a total of about 16, 17 counties that are currently have declarations. So here's the Drought Monitor map. Now this looks at the drought situation nationwide. And when we start looking at these pieces, When the drought designations get to severe, extreme, exceptional is when it kicks into the rules that we can use the drought-related sales of livestock. So you can see what counties are there, what states are involved, and where the highest levels of drought conditions are. The white areas, no drought whatsoever to the present time. So like I said, you're looking at severe, extreme, or exceptional drought when we get into evaluating whether or not we can apply the drought sales of livestock rules. So two different sets of tax treatments. Both of them apply to sales in excess of normal. Now, what does that mean? Excess of normal, we're really looking back at the past 3 years, looking at what we would normally sell on a year-to-year basis of our animals, whether that be market animals or cows, livestock, breeding animals. Again, it's excess of normal or excess of usual business practice, and it has to be due to a weather-related condition. Now, the first rule applies to any livestock, and it's deferral of income for 1 year. Now, in red, you can see the actual code, revenue code section. Really don't want to refer to those. We're going to look at deferral of income for 1 year being the first. The second rule applies to sales of livestock, any livestock other than poultry, but those animals are held for draft, breeding, and dairy purposes. So the first one applies to any livestock, including poultry, market animals, breeding animals, doesn't matter. The second only applies to draft, dairy, breeding animals, definitely excludes poultry. So when we have our sales of these animals, we have two types of taxable income that arise. When we have market animals, sale of calves, it's ordinary income. These are items that we normally be turning over within a very short amount of time. It looks basically, like I said, market animals, stocker calves, sheep, lambs, etc. What we have also as ordinary income, if we've got purchased breeding livestock that we're selling, and we have depreciation against those animals, then that depreciation recapture is recaptured as ordinary income. So market animals sold, depreciation recapture as the other side. Depreciation recapture applies when we buy a breeding animal. We put that animal in the herd. We depreciate that animal over its normal productive life or the tax life. 5 years typically for breeding for beef animals, 3 years for hogs, pigs. So that's the time span we're looking at. Typically, if we held those animals long enough, that depreciation will go down to zero. So the basis is zero. So no matter what we sell it for, that's typically depreciation recapture, again, ordinary income. Now, capital gain income applies from breeding animals, and it's the sale proceeds in excess of what our original purchase price is. That being for purchase breeding animals. If it's raised breeding animals, it's the full value of what we sold it for. So if we got raised breeding livestock, we typically, or we always deduct the cost of raising that animal from the day it is born until the day it goes into the breeding herd. Consequently, that animal never has a tax basis. Therefore, when we sell that animal, all the income generated from that sale is given capital gain treatment because, again, it was for breeding purposes. If we buy it, again, it comes back to we've looked at the purchase price less depreciation, that being ordinary income. If we buy that breeding animal, let's say we buy a bull, we pay $5,000 for this very good bull, and we later sell that bull for $6,000. We depreciated it down to zero. We've got $5,000 ordinary income. We'll have $1,000 of capital gain income. So you can kind of get an idea of how this plays together and why it's important to kind of understand the tax rules, because capital gain is given a much more favorable tax treatment. We only have 3 capital gains rates: 0, 15, and 20. Ordinary income rates start at 10 and go up to 37. So when you're looking at it, capital gains rates much lower, and they kick in at a lower, much higher rate. So it's always beneficial if we can make sure that we have capital gain income and get the capital gain treatment. So now we're going to look at the first issue. Okay, so like I said, you've got two parts. One that applies to all livestock. That's deferral of income for 1 year. We'll talk later about the second issue or option, which is the 2-year or breeding livestock, breeding dairy, draft animals, and their tax treatment's a lot different. So the deferral of income for 1 year, again, has to be from drought, flood, or another weather-related condition. And it has to be severe enough that the area is designated as eligible for federal disaster assistance. Now, coming from the president, the FEMA records is where you're going to have to go to find those, to get those federal declared disaster areas. When we have that, we get to take advantage of this deferral of income. What we have to show is the weather-related condition caused the sale of more animals than normal. Another rule or requirement is the farmer, rancher, has to use the cash method of accounting. Two methods of accounting, one's cash and one's accrual. Most of our farmers and ranchers, most agricultural producers will use the cash method of accounting. There's less than 2% nationwide that use the accrual method. The accrual method uses inventories. Consequently, this deferral of income for 1 year doesn't come into play because by using inventories, we've adjusted everything and we don't get the benefit. So cash method of accounting, show the weather-related condition caused the sale of more animals than normal, more animals than what we would have normally sold in the prior 3 years. Remember, it applies to any livestock. That includes draft breeding dairy animals, market animals, poultry, sold to any weather-related condition or due to that. What happens is the sale proceeds for those animals sold in excess of normal can be deferred to the next taxable year. What this does is it allows that income from those excess sales to be taxed in the year we would normally have taxed them, not in the year that we were forced to sell them early because we've lost the benefit of feed, lost the benefit of water. Consequently, we'd be spending more to keep them than they would be worth when we sold them. So there's the reason for the deferral. We're leveling out the income so that we don't capture it all in 1 year. So the rules that have to be met by the taxpayer. Well, the principal business must be farming. This creates a lot of confusion. There's a whole lot of rules out in the tax code talks about principal business. And for this situation, more than half of our income has to be coming from the farm operation. In others, it has to be a larger amount of farm income. This one's much simpler. So principal business farming, we have to use the cash method of accounting. Then we have to do some calculations. One of the things we've got to show is the animals would have normally been sold in the year following the drought under normal conditions. So that's where we come back to this 3-year period. We look at the sales, normal sales for the prior 3 years. Then we kind of get an idea of, well, here's how many animals we sold in excess of that 3-year average. Those are the ones we're allowed to defer the income from. Then we have to be able to show the weather-related condition that caused the area to be declared eligible for federal assistance must have caused the sale of our animals. That is very easy to do. Now, one of the neat rules about this, livestock do not have to be raised or sold in the declared disaster area. So if that county is not declared, but you had to sell animals from an area that was, you get some benefits. All we have to show is the better weather-related condition that caused the area to be declared eligible for federal assistance, caused the early sale of the livestock. Now, I'll give you an example of a scenario that I saw a few years ago. We had a farmer, a pretty good sized rancher in central Oklahoma. Central Oklahoma was in a drought. He sold a lot of animals in excess of what he would normally have sold, close to 1,000. But these animals that he sold were actually on pastures in Kansas where they were about ready to be coming off of pasture anyway. So we sold those animals a little earlier than what we normally would have, so that we could move the animals in Oklahoma to pasture in Kansas where we weren't experiencing the drought. So we did have a sale of excess animals due to the weather-related condition in Oklahoma. The weather-related condition in Oklahoma was declared a federal disaster area. Consequently, by having land in two parts, we got to take advantage of, or he got to take advantage of the fact that animals were sold due to weather-related conditions, even though the animals that he were sold were actually on pasture in Kansas, but he did sell them early, but they were closer to a market ready age and weight than the calves that he had here in Oklahoma. So it gives the benefit of the doubt to the producer, and it doesn't create a situation where we are forced into doing things that really do not fit a good management practice of selling livestock. Something else that can occur, the animals can be sold before or after the declaration occurs. So if we've got a situation where we're running out of pasture, we know we're going to have to buy feed. We don't want to do that. We sell the animals early before the declaration. The declaration comes in, say, a month or two later. Just because it comes in a little later, we've already sold the animals, doesn't mean that we cannot take advantage of the weather-related rules for this 1-year deferral. So we don't lose that ability. It still holds with us. It works. The next thing we've got to do is be able to prove our history. Again, what would normally have been done with those animals? When would they have been sold? What years? Again, that is that 3-year history. We're going to need to explain why those animals were sold prematurely. Essentially comes back to the drought information that we provide on the tax return. Now here comes the how it's treated. So the sale proceeds from those animals that we sell prematurely in excess of normal. That amount of dollars can be deferred and reported as income in the year following the actual year sale. So if we normally would have sold those animals in 2023, but due to the drought in 2022, we got rid of them, we would simply apply the drought rules, show that we would normally have sold those animals in 2023. Due to shortage of pasture, animals were sold in 2022. That amount of money can then be moved to 2023 and taxed then. Again, it saves the bunching of income. That's a major player in terms of what we do to try to accomplish good tax management strategies. So here's an example. I'm using cows here. We normally would cull 20 head of cows annually. Due to drought conditions, we sell 30. So we're showing we're going to sell 10 more than what we normally would. The farmer or rancher elects to defer recognition of income for 1 year for that 10 additional head. He attaches a statement to the return so that he would normally have sold 20 head on an annual basis, but due to the weather-related problem and his county being declared a federal disaster area, he elects to defer the income from the 10 cows forward to 2023. That shouldn't have been 2022, that should be 2023. So do we have questions? We're going to swap gears here. So this is a deferral of income for 1 year. The next one we're going to look at is the replacement animals for draft breeding and dairy animals. Seeing no questions, let's continue on. So now we get into what we call the involuntary conversion rules. The reason we've used different terminology here is simply because that's the way it's in the tax code. Now remember the 451G rules, and these are 1033. One is the deferral of income for 1 year. The involuntary conversion is treated a little differently. So what we're looking at under this rule, we have animals we're selling early. The rules state we must repurchase those animals. So those draft breeding or dairy animals sold due to drought within 2-year period. So for sales in 2022, we have until really the end of 2024. And in certain situations, if the drought continues long enough during 2022, we may have it until 2025 to repurchase those animals we sold in excess of normal. Now remember, this doesn't apply to poultry. It doesn't apply to market animals. So it only applies to draft animals, breeding animals, or dairy livestock. So the cows, the bulls, etc. Now, one of the provisions in this, drought often doesn't just last 1 year or 2 years, often lasts longer. And what we built into the tax code is the ability to extend that from the normal 2-year replacement to 4 years. But in order to do that, the area has to be declared eligible for federal disaster assistance in order to accomplish this. So it has to be a federally declared disaster area. Then we can go from 2 years to 4 years. Now I've got a situation in Oklahoma. I've got a county that's been in extreme, exceptional, severe drought for the past 13 years. For that county, we've kicked the can down the road so far that our replacement period is now, we have to be replacing within 15 years of when the original sale occurred. So we've got 2 more years after the 13. So this can go on for quite some time. We kicked the can down the road. The Secretary or the Secretary of the Treasury can further extend this again if the drought continues in those severe levels. So there's a lot of room for adjustment, and you've got the ability to make adjustments as we go along. Now, one of the things that's rather unique, draft breeding or dairy animals held for any length of time and a weather-related condition caused a sale. So they don't have to be cows in the herd. We have a situation where we've got heifers that we've held back and we're going to go into the breeding herd. They're only a year old, but they were designated as being breeding animals. Therefore, they qualify for this involuntary conversion. So we don't have to treat that sale as ordinary income. It can be treated as capital gain income. And that gain that's realized from that sale can be postponed if the sale proceeds are used to purchase replacement livestock within that time period that we described, that 2 years normal circumstances. The other requirement is the replacement animals that are going to replace those that we sold have to be used for the same purpose. So we're looking at dairy cows for dairy cows, breeding cows for breeding cows, bulls for bulls, draft animals for draft animals. Mixing and matching is not allowed. So they have to be used for the same purpose. And we have to make the decision to buy them back, replace them within the prescribed amount of time. So here comes the rules for that exceptional, extreme, severe drought. If it can persist, we'll talk about this in a moment, that replacement period can be extended. So you're looking at until the replacement period being extended until the end of the taxpayer's first year that the drought has been declared over. Now, in order to determine that, in red here is an IRS notice. The IRS publishes every September a listing of counties nationwide that fall under the drought rules. So every September, they go back the prior 12 months, they look at all the counties nationwide. They list those counties that qualify for exceptional, extreme, severe drought, as well as the contiguous counties. Those are the ones that we look at for this replacement period being extended. So there's a lot of information out there we can find that, again, provides this opportunity for this deferral or this postponement. So the applicable region, well, it's the county that has experienced a drought condition, as well as all contiguous counties to that county. So it could be as many as 5 or 6 counties that actually touch that county that are allowed the same drought sale rules as the county that experienced the exceptional, extreme, or severe drought. Rule state 2-year replacement period. That replacement period holds unless we get a federal disaster declaration. So if we don't get a federal disaster declaration, we're simply looking at the drought monitor. Holds for 2 years. If we get a disaster declaration, it goes from up to 4 years to replace those animals. And again, that 4-year period starts at the point or the year end where we no longer are in a drought, and we have 4 more years then after that point to get them repurchased. And one of the things that we run into is a situation where you're kicking the can that far down the road. So a drought occurs in 2022. It is a federal declared disaster area. We have until 2026 to buy them back. We have to realize that we're going to have to buy those animals back within that 4-year period. We don't have to buy them all back in 2026. We can buy some back in 24, some in 25, some in 26. As long as we replace this, that same dollar value, doesn't have to be head for head, but dollar value, we can successfully defer the reporting of that income. The animals that we buy back are then put on our records, and we don't have to declare that income until those animals are sold at a later date. So the 2-year replacement period, non-federally declared disaster area, 4 years, if we get disaster declaration, the Secretary of Treasury, again, extend that for drought areas persisting 3 or more years. So again, when you've got a county like in Oklahoma where it's just declaring it 13 years in, they've got 4 years after the end of that drought period to buy those animals back. Now, requirements. No requirement that the weather-related condition cause the area to be declared a federal disaster declaration or receive one. All we have to do is show that the weather-related condition caused the sale. This is where that drought monitor comes in. So the drought monitor is a non-disaster declaration. All it does is show us the levels of the drought, whether that being moderate, extreme, severe, etc. As long as we hit the top 3, the drought monitor can then get us that replacement period of the 2 years. So no requirement. We don't have to have a federal disaster declaration. All we have to do is show that a drought existed. The drought monitor makes it very easy to do so. Consequently, that's all we have to include with the tax return in order to get this tax treatment where we defer the income until those animals are later sold. So we get the replacement ability. What we have to do is show that the weather-related condition caused the sale of more animals than normal. And again, this comes back to that 3 years prior to the current year or drought sale year. We look at number sold each year, that becomes the average. And then we look at this year, the drought year, and determine how many animals we sold in excess of our normal average. That's what we have. That's going to be our excess sales. Now, like I said earlier, you don't have to replace animal for animal, but those animals that were sold gives us then the sale price for that, let's say it was 13 head more than normal. The sale price of those 13 head is what we have to buy back. So we sold the 13 head, we got $26,000 for that. We have to buy $26,000 of replacement animals in order to effectively postpone the recognition of that gain. If we don't spend $26,000, we amend the return in the year of sale. That becomes then taxable in that year. If we buy more than the $26,000, we'll have some depreciation that we can take in future years. Making the election, all we do is like original. On the other, we have to attach a statement to the return. We have to show that the weather-related condition caused the sale. Evidence of that, drought monitor, presidential declarations, etc. We have to compute the amount of gain realized. That's the sale price of the excess animals sold. How many of each kind were sold? So the number and kind of animals. So if we sold beef animals, we remember we're buying beef animals back. Dairy cows for dairy cows. So we're going to have to show what the number of kind of animals sold and what would have been sold under normal or usual business practice had there not been a drought experience. So those are the big things that have to be on the return. Here's a good example. So we have a rancher. On an annual basis, he normally culls 30 head of cows. Due to the drought conditions in 2022, he sells 45 head. He can elect to defer the recognition on that by attaching a statement to the return showing that he's going to be replacing those animals. That's that 15 head, that's sales in excess of normal, within the 2-year replacement period, unless we have a federal declared disaster. So he sells the 15 head. Let's assume he sold them for $50,000. That means he has to buy $50,000 of replacement animals. Those can be heifers, those can be cows, but they have to be beef animals that are going into the herd, into the breeding herd, and they have to be purchased within the required time period. So the rules are, if he spends less than the $50,000 for the replacements, then he has to amend that 2022 return. He has to pay the additional tax plus interest, no penalty, just the tax plus the interest that he would have been owed since he postponed or didn't follow through with what he intended to do. If he spends more than $50,000 for replacements, then he's got some amount in excess of that that's going to be depreciated on his future tax return. So if you look at the current rules, he could probably write all of that off in the year that he purchased them. If he spends exactly $50,000, he does nothing more. Now the rules state the reason why this is kind of unique. So if he spends exactly $50,000 for replacements, and let's say the amount of his tax basis in those animals that he sold was zero, the basis in the new animals is zero. So when he sells those, when they're at some point in the future, he will have some ordinary income or capital gain income that's going to have to be reflected. So ordinary income or capital gain, depending upon what kind of animals they were, will exist in a later date. So here's a kind of a unique scenario. So we normally raise breeding livestock. We don't buy them, we raise them. And if we sell those and we buy some replacement heifers, those replacement heifers, even though we purchased them, have a basis of zero. So when they're sold, they get capital gain treatment. So again, a very unique set of rules apply when we have weather-related sales as to how the tax treatment occurs and some of the benefits that apply. So replacements, remember you have 2 years to purchase those replacement animals unless the drought condition continues. Have to replace as many dollars as was been sold to postpone all the gain until the new animals are sold. That repurchase can be staggered. All we have to do is keep track of dollars spent in tax basis. Now, one thing I didn't cover here, there could be a situation that occurs where we can't replace those animals because let's say that some of the pasture, we had a oil spill or something that basically ruined the land. We're not going to be able to produce any grass on it. Consequently, when we lose some of that, we can make some differences in our operations. We really don't want to go into a whole lot of detail here, but there are times that a situation does occur where we can't replace cows with cows, and we are allowed under certain conditions and certain times to make some revisions in our plan and replace that dollar value of sales with something other than breeding animals, etc. Now, like I said, when we replace those animals, information we're going to need, gross sale income from the cows, the remaining tax basis. Now, I've touched on this a little bit. So on our cows that we sell, let's say we've sold $20,000 of animals in excess of normal. That's the gross sale from those animals. If they would have been purchased animals, and we may have had them long enough that the basis is zero, or we have some raised animals basis is typically always zero because you deduct the cost of that. So the purchase cow basis is purchase price less the depreciation taken. The fun part is when we do this and we buy or sell those animals, we allocate the tax basis from the old cows to the new cows. That allows us the opportunity to adjust the gain recognition, and it'll apply to either the new cows, that we purchased or the purchased cows that we are replacing or we use to replace the raised animals with. So this sounds technical, and it kind of is, but when you start working with your tax preparer, they'll understand what we're talking about. So a raised cow, if we sold a raised cow and we buy a replacement, the replacement animal, the basis in that is 0, and it takes on the same type of treatment as that raised animal. When it's sold, we get capital gain treatment. If we purchase a replacement for a purchased animal, same kind of scenario, except the purchased cow, its basis will be that of what we had in the place of the one we sold. So if we hadn't fully depreciated that cow and she still had $500 of tax basis, we buy a new one, that cow's going to have $500 of basis as well. So there's some ways that we've got to think about. We've got to keep good records when we do this in order to make sure that we get the full benefit of the tax treatment, where we can postpone recognition of gain until those new animals are sold. So tax records will always win here. So let's go through tax basis and explain this a little bit in further detail. Might should have put this up front, but I think you needed to hear what was always going on. So when we have tax basis, that's the value on your books when that on your current year's tax return. So if it's purchased property, you purchased this property some time ago or even this year, your basis is going to be the purchase price plus any acquisition costs, less any depreciation that was allowed and taken. Inherited property, let's say that those cows were given to you. Your fair market value on the date of death of the person or inherited, so that not given, but inherited. So they go from one estate into you, the operator, your basis is the fair market value of the dated death of the decedent. So those cows may have had a 0 basis. They may have completely been depreciated, have 0 basis for the decedent, but now you get a step up to the current value as of his date of death or her date of death, and you get to start afresh. A great benefit. Property received as a gift. Well, if somebody gave you the cows, your basis is the same as the person that gave them to you at the time the gift was made. Now, adjustments, again, depreciation taken, that's a reduction. If you make any improvements, that's an addition. Usually we're looking at land type items when we have improvements. So terraces, ponds, etc. So we're going to replace the cows again. Here's the information needed to determine the tax basis. Total cost of the new cows. How much did we spend for the total bunch? The sale value of the cows that we sold that were in excess of normal. You then allocate the purchase price. Consider the sale value of all the animals. The tax basis of the new cows sold in excess of normal then become the basis of the repurchased animals. Now, let's go through this a little slower. So the total cost of the new cows. So we buy $50,000 of the animals. We sold $50,000 of cows in excess of normal. Our tax basis is going to be the same as what it was because we bought the same number or same dollar value. No change, no difference. We just apply that basis to the current number of animals that we bought back. So we sold 50, we might have to only buy 40 back. Consequently, we're going to allocate the basis among the 40, the same as we would have allocated among the 50. So it comes out the same, even though it doesn't sound like it should. So we start looking at the rules and is trying to determine which option to select. Like I said, the first option, that's the election to defer the recognition of income for 1 year, can apply to all animals. Whereas the second option, that's the postponement of gain by buying them back, only applies to draft, breeding, or dairy animals. The option of which one? Well, I get this question a lot. What should I do? Well, it's not an easy answer. It depends upon your economic situation or the producer's economic situation, tax situation, and goals. So what works for one person is not optimal for another. Another thing to keep in mind, The election to defer for 1 year, we can change that election and then treat it to repurchase those animals. But if we elect to buy them back and then decide that we want to go the other direction, can't do the reverse without getting approval from the Secretary of the Treasury. So IRS has to approve the flip-flop from 1033E to 451G, but it doesn't have to, you can make just a simple election to go the other direction. So when we start looking at which one of these to pick on, use, utilize, etc., there's some things to look at. What is our future personal and business goals? Are we at a point where we want to scale back the business? If that's the case, we may want to go ahead and recognize the income from that sales in excess of normal and not even consider buying them all back. Using the money from the cattle sales to get into or expand into another farm enterprise. We want to get out of the dairy business and we're wanting to do something else. We want to go ahead and recognize the income, so it's only going to be a 1-year deferral. If we want to truly get back into the cow-calf enterprise, we may want to look at buying them back. So the election then to postpone gain by repurchase. If you're looking at helping someone else take over your farm, as a transition plan, this may be an opportunity to let the new person buy some animals and again, report the income. Retire and never look back is another option. Some other things to think about: current and future income and expenses. If we expect income to be growing in the next several years, it might be worthwhile to go ahead and take the tax now, pay the tax on it. Potential tax rate changes. Wish we knew the answer to this. No idea. Something else to think about. So these are some points to consider when you start to evaluate which option will result in the best overall outcome. So the information that we've talked about here, and I provided the PowerPoints and also the weather-related sale fact sheet to Sarah. She has that so that you can, I hope she'll send those out. If you have or wish to request them, send her a request. She can send those to you because I provided it to her. When you're looking at this, if you're the tax preparer or taxpayer, take that information to your tax preparer, evaluate the consequences of both. Remember, what works for your neighbor probably won't work for you. And if you're dealing with your clientele, it's hard to make a decision for all that's going to be to their best interest. Everybody's situation is and will be different. Other things to look at on that return: non-farm versus farm income, tax bracket, income averaging, one of the underused tools developed or given to farmers. Our farmers are the only ones that are allowed to use income averaging to take high income from 1 year and roll it back to prior years where income is less. Disaster payment proceeds, crop insurance proceeds, and prior year NOLs that have been carried forward. All of those have an impact on what our decision for these disaster or drought sales, weather-related sales can be. In a future webinar, we'll be talking about disaster payments and what all goes into those. So with that, I think we spent about 45 minutes. Let's take some questions. Please fire away. Also, if you have questions after this is over and you realize, oh, I'd like to ask those, write down my email address. It's jc.hobbs@okstate.edu. Send them to me and I will respond. Guarantee it. May take me a day or two, but I will get you an answer. Sarah, I'll turn it over to you.
We've got a couple of questions, and they came in after your first kind of pause and break for questions. The first question was, what if you end up raising more replacements to become breeding cows instead of buying in replacements? Are you required to still buy the same number of animals back within a replacement period? Can you furnish your own?
The problem with furnishing your own, and I should have alluded to this, those animals have no basis. So if you're going to replace them with your own, go the 1 year deferral of income. because then you're going to spread that income over 2 years, but you cannot postpone recognition of that by simply raising your own replacements. That doesn't work. You're going to have to buy some kind of replacements to come into the herd. Otherwise, this does not work. So replacement animals must be taken into consideration for this, the postponement of recognition of gain.
Thanks, JC. And then
Next one.
Yep. So the next
Involuntary conversions. Attaching the statement of the current year telling IRS you've excluded 50,000, and then in the future you spend exactly that on the replacements. There's nothing more to do. Basically, that is correct. You say nothing more to do. You'll have to show on the tax return in the year that you bought the replacements, how many you bought and how much you spent. But yes, it's very simple. Then you're doing nothing more than just reporting a extra piece of paper with the return, showing that you bought back exactly the same number as what was sold, and you do not have to do anything in terms of adjustments on the return itself. So that is exactly right, and you understood correctly. Other questions? One thing, let's go into that question a little deeper. So if you actually bought $52,000 of animals instead of the 50, then you're going to have $2,000 of depreciation that's going to show up on the depreciation schedule. So even though you spent more than the 50,000, you'll have $2,000 of depreciation. And under the current rules, you can take right off that full $2,000 in the year of the purchase using either the code section 179 expensing election rules or using the bonus depreciation rules that are in effect at the present time. But if you spend less than the 50,000, let's say you spend 48,000, you'll have to go back and amend the return in the original year and pay the tax and the penalty on that $2,000 of income that we didn't use to replace those animals.
That is all the questions we've received so far. We did get one question about where can folks find more information on federally declared disaster locations. So FEMA.gov hosts that site. And then also I posted a link to an FSA fact sheet on disaster designations and FSA's website on our disaster page. We also have a list of all the secretarial designated ones. You can even go back and see prior years. I'll drop a link in the chat.
Those are great. And if they want to use the drought monitor, the same thing. You can go back and look at prior years there as well. And so you've got lots of opportunities, as well as, and this is not very well known, but the IRS website, irs.gov, if you look at the replacement rules, they keep those IRS notices back. The other day I was looking for one for 2010 and I found it. So you can go back a lot of years looking at their information for these as well. So there's more than one source of that information. If you can't find it, send me an email and I'll help you locate it and get it to you.
Yes, there's a question about, will this webinar be able to be viewed later in its entirety? It will. What we're going to do is we have recorded this. So it just usually takes us a couple of days because we got to get the captioning and everything squared away and make sure the format works. And then we will post a link to it online so folks can stream it. And we will also have, you'll be able to download the slides and some additional fact sheets like the materials that JC referred to earlier on the rural tax info sheets.
And if they have questions after watching, send me an email. Happy to help.
Do folks have any other questions? Somebody asked about the slide decks are going to be posted on farmers.gov/newfarmers. So when you go on farmers.gov, just like you did to register for this webinar, you'll be able to see it there. And if folks don't have any more questions, we do hope that you'll be able to join us tomorrow for our next webinar. JC, do you want to give just a quick preview and a summary about what we're going to be covering tomorrow?
Tomorrow's a situation we're going to be dealing with disaster and casualty losses. So probably the best examples is you were hit by a hurricane, your farm was hit by a tornado, some property damage, fires, etc. What is allowed to be deducted? How do you determine what the deduction amounts are? What happens if we have insurance proceeds that we get back? Tax treatment of disaster payments. So we're going to use a variety of examples to talk about how different pieces of property, whether it be personal use property or business use property, the loss of that, the damage of that, what we need to do and be aware of when we file our tax return to either get a deduction or whether or not even in some situations where under the current tax law, we don't have any deduction from that. So we're going to cover, again, casualty and disaster losses tomorrow.
Thanks. I don't see any more questions in the chat. So thank you everyone for joining us, and hopefully we'll see or connect with some of you tomorrow.